It's time for Editor's Cut. And Alex, I'm looking forward to you playing the devil's advocate on if it's even remotely possible to do that on metals today.
Yeah, in fact, I liked Niraj's headline for this particular one. He says, no Metallica in sight. And I thought, why not stretch that a little bit? I'm taking full liberty here. I know that we focus on equities quite a bit, but it's sometimes important to turn the page because it's sad but true. Sometimes you have to focus on commodities and metals because nothing else matters. But all of that has a bearing on stocks as well. So let's talk about iron ore, which really is the reason why we're having this conversation this morning.
Let me do one better. Iron ore doesn't seem to be tailored for swift moves, Alex.
Oh, very good. But that's on the opposite end of the spectrum from Metallica. Having said that, let's talk about why we're talking about iron ore. It has to do with China.
Yeah, so yesterday's price move effectively brought us to think of metals and why they are in focus. So I'm starting off with iron ore, of course, but extending this to metals at large. So iron ore cracked over 7% yesterday, right? That's a large plunge. This was the biggest fall since mid-2022. Now, you would argue that with the kind of economic data China has given out, on any given day you could have such falls, but this was particularly large because it dates back 2 years, right? Because stockpiles in Chinese ports are highest in over a year. And in some sense, because of the Lunar New Year holidays, because economic activity goes down, you could argue that some of this would have been a result of that. Still, it made headlines, and still it made the prices fall. Still, Vedanta and NMDC corrected, so you got to bring it because economic investors or investors should know about why this is happening. Now, one muted demand. Steel demand in China is lagging too because there is persistent pressure, as we all know, on China realty and manufacturing sector. And, this muted demand from China, and now the Indian implication or global implication, that muted demand for steel or other commodities in China could lead to Chinese authorities extolling the companies that, hey, go out and export. You don't want a glut here. And that may impact the pricing of some of these global commodities. In fact, I was reading a Gavekal research note, if I'm not wrong, or some other note which said this, or a Bloomberg story today, apparently, which said that Chinese authorities have told companies that go out and make higher exports because you do not want a glut here. Now, if that is going to be the trend, that you might see pricing pressure on global commodities abroad. So that's the first part, Alex, of what's happening to the underlying asset class, which is iron ore predominantly or some of the other commodities, and thereby onto steel and some of the others.
So, but a counter to China, and of course it's not something that will pan out in the near term, but countries like Germany, for example, I was looking at a headline this morning, is looking to meet several countries in the Asian region with regard to ties and reducing its dependence on China. So while to a certain extent, a slowdown in manufacturing, a slowdown in demand for commodities in China is something that we might have to bear with in the near term, with a lot of these countries looking outside of China to increase manufacturing footprint, etc. That could be resolved, I would think, in the medium term, right?
Maybe, but again, if the other countries have these manufacturing setups for Chinese production facilities which are set up already, they will have to export it somewhere, so that's part one. By the way, just before we move to the other corollary to this is that a lot of investors are starting to buy into China now, thinking that the worst is over. So there's a lovely story out there too.
Because the CPI print was better, yes.
Yeah, maybe, so maybe that changes. And that's the disclaimer, by the way, that these things on metals could change very quickly. Because one whiff of strong Chinese data and suddenly you'll see the metals zooming. So traders in particular, but investors as well, should keep that in mind. Having said that, two interesting notes that I saw, one on Chinese auto demand. Now, a lot of talk about how Chinese auto demand is very strong. Gavekal research has pointed out that two of the key markets that have powered the auto export boom in China are turning less favorable, with the European Union poised to levy tariffs on EV imports from China and the Russian market close to saturation.
Interesting.
Do we see Chinese auto exports starting to come under pressure? It's a question we do not know, but that could also further impact demand for some of the base metals. That's part one. Part two, real estate. And we know that it's under pressure, but the Jeffries note on real estate speaks about how the real estate SOE developers too have underperformed HSI by 20% YTD. And we know HSI hasn't done well amid sluggish sales, extended property price decline, and fading policy expectations. The physical market appearing unlikely to turn around in the near term.
Because that is the biggest overhang for China
Yes.
at this juncture.
And if that stays, Alex, it's very difficult to make a sustained case for metals and underlying metals and metal stocks starting to move up. So that's the other problem. Now, therefore, all of this, the crux of the matter is, what could it mean for India stocks and Indian investors investing in India companies? Because there are a clutch of very smart investors. Yesterday we had Abhay Agarwal participating in the China story via some ETFs. Some others are doing that too. So some people are doing it well and hedging their bets by going long China. What about investors who are in Indian metal stocks? That's the key question. Can they do well? Now, most brokerages seem to be aligned with the fact that stocks like Hindalco and Tata Steel, which are trading at roughly 1.5 times FY25 price to book, with 11 to 12% ROE, are trading at valuations much better than history, with capex having come on stream. In Hindalco's case, the downside because of the global issues being priced in and volume pickup likely might be a good place to do. Now, these notes are from a clux of 2 or 3 brokerages which are constructive on Hindalco and Tata Steel
and these two
in
counters
particular. These two counters in particular. Now, they may still correct because the metal overhang may stay, but within the universe, these two seem to be more favorably placed than the others. We know that NMDC and Vedanta will hurt with the recent pressure on iron ore prices. So even if valuations are cheap, currently with iron ore doing what it is doing, and we'll monitor it today, by the way.
To see if there's a pop.
Yeah, so our news flash screen will be busy with what's happening in iron ore and other base metals. So that will determine the near-term trend, so not commenting too much on that. And the last piece is from amongst the largest stocks is JSW Steel. Now, the valuations are not cheap there at all by any stretch of imagination relative to any other company. But again, some very interesting capex done, has come on stream, will come on stream. Their guidance for volumes, 37, 38 million tons in FY25 and even higher in FY26, means that higher valuations might be okay for players who are looking at a 2-year perspective, believing that prices will not correct too much from here because volume growth will make up for earnings, and that will make up for the slightly more expensive valuations than the others.
I'm obviously not going to be able to play devil's advocate to the extent that I will argue against this. But could it be that some of the excitement and some of the positive view on these counters is because of domestic demand? Because while we've talked about China, we're talking about several companies that have moved away from the export scenario to focus on India.
Yeah, I mean, a growing Indian sales presence doesn't take away the export output that would still be there for these companies. But near term, Alex, just that overhang will stay. That until China turns around the corner, you don't want to go out and bet big money on metals because the outlook just seems so volatile and uncertain. So why do that in such a scenario, wherein there is an overall risk of maybe the market valuations also coming off?
So watch the underlying as well, and watch the underlying today because of the kind of crack you saw in trade yesterday.